This is Radio Free Wall Street with Lee Adler, on the web at radiofreewallstreet.fm and wallstreetexaminer.com. Hi everybody, this is Radio Free Wall Street for Tuesday, September 16th, 2014. This program is being recorded at 4:40 p.m. New York time. As you know, I've been traveling for the last 5 or 6 days, visiting family, heading back to Florida. I've made it back here and been a little bit out of touch with the market over the last few days. Yesterday, I got back late in the afternoon and started tracking things, and then today got caught up on some of the data. So it'll take me a little while to get back in the swing of things and get a feel for what's really going on. Bit of a surprising day today with this hard bounce off support on the S&P at 1980.82, that area. The technical indicators had looked a little heavy, a little soft on Monday, and it looked like there might be a breakdown, but we always wait and see if support is going to hold, and it has. Haven't run the numbers yet for today, but we'll have a market update posted a little later this evening. And then tomorrow we have the FOMC meeting, and I'm going to produce a Fed report after we see what the Fed has to say, and we'll look at some of the actual numbers out of the Fed and the ECB. Interesting things going on there. Their balance sheet is still shrinking. The TLTRO, which is the targeted long-term lending operations, which is supposed to spur borrowing, spur credit growth in Europe, begins now. The asset-backed securities purchases will not begin until October. I'm skeptical about both of those. We're also going to take a look at a couple of things that were in the news today, see how the news media treated it, particularly the Jon Hilsenrath story and the story on industrial production yesterday, as well as the information that came out today on median household income. As usual, I have a slightly different take on these stories than was presented in the media. So yesterday, as I was coming down the road, stopping to lighten my load once in a while, I was listening to Bloomberg, and it seemed like every 10 minutes when they were giving the news, all they could talk about was the story that industrial production had dropped by 0.1%, and that was the reason the market was weak every 10 or 15 minutes. And of course, those few times during the day when the market was up, then they were saying, well, the market was up in spite of industrial production dropping 0.1%. Of course, that figure was wrong. That was the headline number was the seasonally adjusted fictional number, which doesn't exist in reality. So I took a look at the actual data, and rather than go through the numbers and bore you with that, I just thought it would be interesting to look at a picture. And up here we have the industrial production index on an actual basis, unadjusted, not seasonally adjusted. And you can see the patterns going back year to year, that there's virtually no deviation in the trend. The light green line is the August trend, and there's a little bit of some undulation, but pretty much on trend, and a new high, in fact, a new high in total industrial production. Now, don't forget that's skewed by energy production. We'll look at that in a minute. Down here is the annual rate of change, and it's running right in here, pretty much where it has been, 3% or so, a little more sometimes, a little less, but pretty much right in the middle of the range that it's been in the past couple of years. Interestingly, I overlaid the Fed's System Open Market account, a measure of QE. You can see it beginning to flatten out here. What we have up here is a runaway blow-off situation, it looks like to me, and this goes back to my theme that the economy is overheating. Still, virtually no one has picked up on that, but that's what the actual data shows us. You can see the parabolic nature of this curve in here, and it certainly looks like the economy is accelerating and blowing off, and we're doing all the same kinds of things we were doing at the top of the housing bubble. This chart is the S&P 500, and the green line connects the same date year to year. So again, you can see that the curve there is accelerating. And also, look at how closely these year-to-year lines on the industrial production index mimic this line here. Do businesses take their cues from the direction of the stock market? They sure do. So as the stock market continues to hover around this 2000 level, probably you're going to see animal spirits pick up even more. So we're getting close to that time where the Fed is going to be encouraged to pull the punch bowl on the basis of this data. They already have, essentially, by ending QE, and I don't think there's anything that's going to make them deviate from that. It's going to be very interesting to see what they have to say about that tomorrow, and that brings up another issue, the discussion of why the market rallied today, and I'll get to that a little later after I go through the charts. Now, lest you think that everything is hunky-dory, this is a chart of industrial production, excluding anything that's energy related. And here's where we are right now. And if you draw a line back in time, just to extend a horizontal line back in time, look at where we are versus the recent past. We are finally above the level reached in 2008. And remember, 2008 is when the market was crashing, when the economy was crashing. And again, going back a little further, we're actually approximately at the level slightly above 2005, but below the level of 2006. Considering everything, we're not back to the peak levels of the bubble when you exclude energy. The rest of the economy is lagging. It's doing poorly. We've heard these stories before. The energy production is what's skewing this whole thing higher. This is the monster that's driving the growth in industrial production. This is oil and gas extraction. And you can see this speaks for itself. It's rising on a parabolic curve. God knows how long this can persist, but it's certainly what's driving whatever growth we're seeing in the U.S. economy, particularly relevant to the rest of the world, which has not seen the same kind of energy boom that the U.S. has as a result of fracking. Right now, the growth rate in oil and gas extraction is at about 11-12%, slightly off the recent peak, which was closer to 14%, but still running red hot and skewing all the other industrial production measures higher. So today, the big story was ostensibly the reason for the market rally was a piece by Jon Hilsenrath in the Wall Street Journal claiming that the Fed was going to maintain its language, the two words, considerable period. And this was ostensibly the reason that the market rallied. So Jon Hilsenrath writes an article and says the Fed isn't going to change two words in the FOMC statement, and this is the reason the market rallied. Let's go on. Another media pundit, a guy at the Financial Times, said that the Hilsenrath article was the reason that the dollar sold off today. Well, I don't get the connection there, but I thought it'd be interesting. Let's take a look at that dollar chart because this rally has been persistent and it's showing signs of breaking out. My take on the reason for the weakness today, such as it was that it had reached its major resistance level at 84.50 and was going to pull back a little. But the big picture is very different. Here it is. This is a chart of the U.S. dollar index that I feature every week in the Wall Street Examiner Professional Edition Treasury Update, which I didn't produce last week because of my travels, but we'll have one out again this Friday or Saturday. But this is the weekly chart of the dollar going back to 2010, and I superimpose some cycle wave analysis and support and resistance. And you can see that it broke out of this nice little base pattern here a couple of 6-8 weeks ago at around 81.50, and it's pretty much reached its objective up here at about 84.50. So we should get a pullback, and again, here's the long-term trend line going back to the 2010 peak, and maybe we'll get a pullback into this area over the next couple of weeks. I don't know. I haven't looked at the short-term chart yet to see. There's still a lot of upward momentum. Look at the 18-month cycle momentum down here. It's it just broke a 2-year downtrend line. So that suggests that the long-term trend is turning up. 3-year cycle momentum also broke a long-term trend line. That's an even bigger indication that the long-term trend in the dollar is turning up. And you can see that the cycle oscillator hasn't quite made a turn here. And long-term trend momentum is still oscillating in a range, but it has crossed over its long-term smoother. And the long-term trend momentum oscillator is still rising. So all of these indications suggest that, perhaps we'll get a little consolidation or pullback in this area, but the dollar should break out. Now, why would that be? Well, the Fed is not printing as many dollars anymore. They're going to slow down to a quote-unquote trickle in the printing of dollars in 2015. Meanwhile, the ECB and the Bank of Japan is just going gangbusters in printing yen, and those are fed into the same pool of worldwide liquidity. And now the ECB is trying to expand its balance sheet, but it's having a problem, and I'll get to that in a second. So you're going to have fewer dollars around, and you have still have an immense demand for the dollar credits. So it stands to reason that relative to other currencies which are being printed willy-nilly, that the dollar is going to strengthen. That's probably not good news for gold. The gold charts have looked awful, and they show no sign of turning around, but maybe a little bit of a rally in gold if we get this pullback or consolidation in the dollar. So the dollar strength here, I think, is maybe here to stay for a while, but the 84.50 level is critical. It needs to get through this level in the next 3, 4, 5 months. If it doesn't do that, then maybe we'll get another rollover. But so far, all the indications of the momentum and cyclical indicators are that it will break out at some point later this year or in 2015, and probably head up to this level here, the area of the 2010 high, which is around 88.50 or so. So we'll keep an eye on this as we go on. Here we have a chart of the ECB's balance sheet. That's this green line here. And total deposits in the European banking system, which is the blue line. And you can see how that tends to follow or move in sync with the ECB's assets. And that's because when the banks pay down ECB loans, they extinguish deposits. And so you can see the trend since 2012 has been down in the ECB's balance sheet as European banks and other participants in the ECB game continue to attempt to deleverage and strengthen their balance sheet and pay off these loans from the European Central Bank. And that's in spite of the recent announcement of negative deposit rates. Actually, it's because of it, because the negative deposit rate increases the bank's cost of funds. And the way to get away from that, if you don't have profitable lending opportunities, is to extinguish those deposits by killing off those loans. As the crisis flares up in Europe and the ECB prints money aggressively, that money tends to leave their system and to seek treasuries as a carry trade or a safe haven. But when banks don't need the money, they like to pay off these loans and sell off those treasuries that they purchased with the loans that they took on back here. And that this process has continued in spite of Mario Draghi's little games. The TLTRO, which is the targeted long-term refinancing operation that is supposed to stimulate lending to businesses in the Eurozone, that actually begins now. So this last downtick as of September 10th in the ECB's balance sheet that brought it to a new 3-year low, it's going to be interesting to see how this TLTRO program is received, whether the banks will actually take that money and try to lend it out. One of the things that I learned in my career as a real estate appraiser and real estate market analyst is that increasing supply does not generate demand. And I think we just saw that with the Revel Casino in Atlantic City. You don't build an immense supply of new casino hotel rooms and an immense amount of casino floor space and all the entertainment venues that go along with it and expect the demand to just be there. So this is the theory, I think, in the ECB's case. that's not going to work also. By attempting to increase the supply of something that there's no demand for, it's not going to have any impact. I suspect that this trend of declining assets on the ECB's balance sheet is likely to continue. The asset-backed securities purchase program doesn't begin until October, so we won't have any idea whether that's going to do anything. Again, I don't think it will, so we'll just have to wait and see. Now, we've seen some weakness in the treasuries over the last couple weeks as yields have risen from the 230 area to the 250 area and prices have dropped. I think that if we continue to see this decline in the ECB's asset base, that this could be a negative for the Treasury market, and we could see Treasury prices falling again. There are some obviously other inputs in the Treasury market that make a big difference there. But don't forget, the Fed is going to be buying less and almost nothing beginning next year. So unless other forces step up to take up the slack, or unless there's a huge reduction in Treasury supply, which doesn't appear to be in the cards, then I would suspect that we're going to see higher yields along the line somewhere. Last but not least is this business about median household income. The Census Bureau released a report today on 2013 median household income. And the big story was that in real terms, median household income was up for the first time, I think, in 5 years, but only by 0.3%. At least that's what the report was. Well, it's 0.3% only if you believe that inflation was 1.5% last year. Here's how that works. In current dollars, the 2012 figure for median income was $51,017. This year, or last year in 2013, it was $51,939. That's an increase of 1.8%. So they're reporting that there was a real increase of 0.3%. That means that the inflation rate applied was 1.5%. And, well, okay, I mean, if you want to believe that inflation was 1.5% in 2013, be my guest. But as you know, government figures uses either the CPI or the PCE deflator, which is the Fed's favorite measure, and neither one of them counts housing. And if housing inflation were included in 2013 at the actual rate of housing inflation, then the CPI would have been probably around 3 or 3.5%. So don't believe this stuff that in real terms median household income was up in 2013, even by 0.3%, because if they had measured it correctly using a real number for inflation, it would have been down again. The middle class continues to take the brunt of these terrible monetary policies. So tomorrow we have the FOMC. It's on Wednesday. It might be by the time you see this. And I'm going to cover whatever they have to say differently or not differently. I'll have a comment or two about that in the Fed report that I'll try to get posted by Wednesday evening. And that's for those of you who do subscribe to the Wall Street Examiner Professional Edition Fed report. And if you don't, I encourage you to do so. I think it's something that you'll find useful in your investing and trading activities. As far as the technicals of the market are concerned, interesting rally today, support held at 1980, 1982, but a recovery to within the range is usually meaningless. I haven't updated the charts yet, but I will get the market update posted late tonight. I have to go visit my mom. I haven't seen her since I've been back yet, and it's been a couple months, so I'll do my family duty and go see her, and then I'll get the reports posted for those of you who subscribe to the market updates. So let's get together again next week, again on Tuesday. Let's try to keep a 1 week interval here. Until next Tuesday, September 23rd, have a great week, trade sane, and I'll see you next week.